All right. So thank you for joining us for the final session of the Fall FCI Live series. We are so excited. This one is the Getting Your Co-op Loan Ready. There were lots of requests for this topic. I would have loved this session back when I was a green GM, because you have all these questions you want to ask lenders, but you're afraid when you ask them, it like exposes your weaknesses. This is your opportunity to talk to two very friendly lenders who are going to share some information about what they're looking for. They work, and this is an organization that works with lots of food co-ops, and they can talk very specifically to what they'll be looking for, take your questions. We're excited to have them here from Shared Capital Cooperative today. And with that, actually, I'm going to go ahead and stop sharing my screen, turn the floor over to Samantha and Mark.
Not yet.
Yes, okay. Oops, 1 second here, folks. Get the screen sharing.
I can see it now.
There we go.
Yep, we can all see it. Looks good.
Great. Okay, well, welcome everybody. And like JQ said, you are at Making Your Cooperative Loan Ready. Welcome. My name is Samantha Bailey. I'm a loan officer here at Shared Capital, and this is my colleague, Mark Sept. He is a senior loan officer here at Shared Capital, and just really excited to be here with you and have a frank conversation about what it takes to get your co-op to a loan ready spot. We actually are fine with you asking questions throughout the presentation, so we'll be monitoring the chat, and or if you would like to unmute yourself at any point, go ahead and do that. So we'll also have time at the end, hopefully, for questions. So a short background on Shared Capital Cooperative. We are a CDFI loan fund based in the Twin Cities, but we have a national footprint, and we have been around for 40 years, formerly known as North Country Cooperative Development Foundation. Fund. Oh, there are so many things going on back then. Fund, and officially Shared Capital. And the way that we build a just economy, which is our mission, is to make direct investments into co-ops of all types, including food co-ops. And then our structure is also part of sort of building a just economy, because we ourselves are democratically owned. We are for co-ops by co-ops. Next slide, please. And so along those lines, our structure, we have 260 plus cooperative members, and those members engage with our fund in a few different ways. One is obviously becoming a borrower. We have 100 current borrowers, a $16 million portfolio, so that's one way you can be a member. But you also can make an investment directly into Shared Capital. Over 50% of our capital comes directly from members. And then you can also be on our board of directors, various committees, including our loan committee that actually makes decisions on loans. So we're here today to talk a little bit about how loan decisions are made, you know, specifically at Shared Capital, but there is some applicability to other CDFIs, and we can also try to answer some hypothetical questions about banks. But we're obviously speaking from our experience here, and then how to prepare for a loan application. So I just want to take a quick pause to see if people have other goals that they wanted to share, and I can kind of make note of that and try to get to those things if possible. Any other goals? Check in the chat. So that sounds good to people? Great.
Great. Thanks for getting us started, Samantha. So as she said, my name is Mark Fick. I'm Senior Loan Officer with Shared Capital, and want to walk through a few things with you today. One is that, as Samantha highlighted, we are a co-op ourselves, and our mission is around supporting cooperatives of all different kinds. Grocery store, consumer-owned grocery stores have been a significant part of our portfolio since the organization started, and have been a significant part of the pool of investments in our funds. And so being a resource, an important resource for the co-op grocery community has been a big part of our identity since the beginning. And part of the reason that has worked so well is that we really focus on the principles of cooperation and the unique model of cooperative ownership when we are thinking about financing. And so we want to respect and reflect the structure of the cooperative, the democratic nature of it, when we think about bringing capital
Your
to.
screen share stop, Mark.
Screen share stop?
Yeah.
That's odd, I'm sorry. Let me see if I can do that again. Back?
Yes.
Okay, sorry about that. And so it's important, and this is a relationship, as we'll talk about a little bit. You are looking for debt financing, and a lender has those resources, and they want to bring those to good businesses around the country. But we can't necessarily always think about it the same way that traditional small business finance has happened in the United States. And we want to think about it a little bit differently because of the ownership model that the co-op has. And so from your side of that equation, as the co-op, we think it is fundamentally important that no matter what kind of capital you are bringing to your store, that the co-op can really honor and respect, especially the three principles that we've highlighted here on the screen. That we remember that the co-op members are investors into that store to whatever degree they can afford to be and make sense for them, and that they democratically control the capital of their cooperative internally. But then when it comes to other capital coming into that co-op, we look at principle 4 and remind ourselves that the co-op should also be in control of any of that capital that comes in. That we want to be very careful about giving investors more control over our store than they should have, and make sure that the members, at the end of the day, are the owners and operators of that capital. And then, of course, because of our model and the nature of how shared capital works, we think it's also important to remember principle 6 and to look for co-op-based resources and utilize the co-op economy to build your co-op store, because that makes the entire co-op economy in the United States stronger. And even as a borrower, it is a form of utilizing the co-op economy and investing, so to speak, in those resources of the co-op economy. And that makes our entire sector and our entire field stronger as a group. And so whatever this experience of lending and investing and finding capital for your store looks like, we want to remind folks to come back to these principles and the structure that they imply. So there's a lot of different kinds of capital out there. And if you're in this session, you've probably been thinking about this a little bit, and you probably have some sense of some of the resources that stores will typically use when they are financing their business, whether that's a startup or whether that's an expansion or a remodel, whatever that might look like. And to oversimplify just a little bit, the money that comes in as capital often sits as some form of debt or as some form of equity. And each of those forms of debt and equity can take a different form itself and a different structure. Everything from on the far left, we see grants and donations and common stock. That's the membership stock that is purchased when members become owners of the store. That's the most flexible money that the co-op has. The co-op can generally do whatever it needs to do with those dollars, fill gaps, use working capital, build the store without too much concern about having to return that money initially or in the short term. As you move towards the right to things that are structured more and more like traditional debt, you need to consider that you're locking yourself into a term of repayment of that debt, or even that preferred stock. And they have different structures of repayment and different responsibilities that come with those dollars. And so the dollars on the right hand of the screen are extremely useful and important, but they come with a different set of assumptions than the dollars on the left hand of the screen. And where does this all come from? It comes from a variety of places, and this is true of most types of co-ops out there, but especially grocery cooperatives, consumer-owned grocery, and worker-owned grocery co-ops. If you attended yesterday's session and some of the other sessions that have touched on some of these issues, where those dollars come from has changed a little bit over the years. Historically, stores used to be able to rely on more debt for their startup or expansion or renovation, and fill the gaps with member dollars or common stock or preferred stock investments. Now those scales have changed a little bit, and it is more difficult these days for a an independent grocery store to be able to afford true debt in many circumstances, or they have to reduce the amount of money that's coming in, that's coming from debt, and look to those other sources to increase the amount of grants or equity or donations or in other forms of investments that are coming into that store. And we're not going to spend a lot of time on that question, but just to note that that has changed a little bit, that typically there is a slightly smaller amount of debt that's coming into a store these days, no matter what they're doing, but often there is still a layer of debt there. And also to remind you that some of the things we're talking about when we're talking about preparing for debt, those same preparations can help you when you are preparing for an equity investment or other sources of funding too.
Mark, there was a question about the difference between subordinate loans and senior loans.
Yes, so a senior loan is going to be what a typical commercial bank is going to provide, where they are going to essentially be first in line to both get any monthly repayments, and also if things go very poorly and there needs to be a workout or the collateral needs to be collected on, the senior loan is also first in line to collect in those circumstances. A subordinate loan may have a similar payment structure to a senior loan, but due to its mission nature or its source of funds, it is able to sit behind that senior loan both in the form of monthly debt service and in collecting on collateral if that needs to be the situation. So a subordinate loan, as you might imagine, is a little bit harder to find sometimes, but there are dedicated funds, local funds, publicly sourced funds, and sometimes CDFIs like ourselves that are able to play that role. Is there another question in the chat?
No.
Okay, great. So what are these lenders thinking? You need money, they've got money, why can't you just get that money and do what you need to do with it? Well, they've got a lot of anxieties, these lenders. We've got a lot of rules that we need to follow. We've got a lot of best sort of guidelines that we try to follow. Part of this is unpacking for yourselves, is unpacking the nature of the lender you're working with. So where does their money come from? And what are they expecting from those investments? What are they conservative in how they prevent losses or shore up for losses? Do they have a lot of flexibility in how they do that? Which other kinds of businesses have they financed over recent years? Do they sit in certain niche areas or sectors of the economy or focus on other areas? And what do they, as a lender or investor group, want to get out of their investment, be a financial impact or a social impact or a combination of those things? All of those different kinds of questions define different kinds of sources of debt financing out there and investment financing. And they all kind of get put together into a funnel that ultimately defines for that lender or investor what their risk tolerance is and what their willingness is to explore and be creative or take on new models of business. Or in the case of cooperatives, a well-established model of business that is not as well known and may not be in their current portfolio. And so some of what you're doing when you're applying for this loan and you're answering these questions and having to provide yet another form or piece of information for that lender is helping them to feel comfortable based on these different kinds of motivators and the context within which that lender works.
Thanks, Mark. Yeah, so kind of digging into our traditional process and how we assess loan requests. These are the broad categories. You might have heard of the 5 C's of cash flow, collateral, capacity, conditions, and character. Banks do that too, but with co-op lenders like ourselves, we are also looking at your ownership structure, who are owners, governance, as well as how patronage is distributed. So for us, it's cash flow, cash flow, cash flow. We are really primarily concerned with how you're going to repay this loan, and cash flow is usually one of the primary ways that we're looking at that. So in the case of a startup, the question of will you make enough money to repay the loan it's kind of an open one. And so there's some different sources of information that we are looking to assess whether or not we think in the future you will be able to generate that cash. Projections are obviously, financial projections are one key piece of information that's informed by a market study, and we're kind of balancing those those two pieces together. And then owner engagement is also huge for us, how many owners have signed on, how have they invested in the co-op development. So that's kind of all informing how we're thinking about your potential cash flow in the future. And the way that we're, kind of one ratio we look at to assess this is the debt service coverage ratio. So whatever, your loan amount has a monthly payment, and, we want to see that every month you're going to be able to pay that loan, pay that payment based on the cash flow that you're generating. And so this is, it's net operating income over whatever that payment is, and hopefully that's at least one. So that's kind of a minimum requirement for us to really consider a loan request to be feasible.
And a few other just comments on that too is, lenders like to see lots of extra cushion and padding and safety nets around their loan and around your business. And so usually with a debt service coverage ratio, we want to know not just if your debt service is $1 every month, we want to know that you have more than $1 every month. We want to know that you've got $1.20 or $1.50 every month, so that you can absorb any unexpected things, deal with any surprises, and still be able to pay that debt at the end of the month.
Kind of the second bucket of collateral and security for our loan. How will you repay the loan if you don't have any money, left over? We're looking typically at equipment and inventory, potentially real estate in a food co-op project, and we usually discount the value of that collateral. Again, to be conservative, we have some anxieties, because you might have bought the equipment for $10,000, but a few years later, if things go south, that might not be worth $10,000 anymore. So we typically are discounting that in our analysis of whether or not your collateral can really cover the balance of your loan. Another source of security that we do sometimes see, which is really great, is guarantees. So those could come from a community foundation that's really invested in your project. It could come from other food co-ops that are willing to make investments into a guarantee pool, kind of escrow account, or however we structure it. And this is something I know it's not very common, but I was thinking about today, was impact investors or wealthy individuals maybe that are part of your community who would like to guarantee, or partially or fully guarantee a loan because they have some capital. So they could come in a lot of forms, and I'm sure as co-ops become more creative with financing and capital stacks, that we'll see even other options for guarantees. And then capacity is really a question of if you have the right people in place and kind of the right financial structure. So obviously GMs, really, really important. We care about who they are and what their experience is, as well as other management at the food co-op. And yeah, are they the right person to be doing this job? We'll certainly assess that. And then also there might be some need for outside assistance, maybe a temporary consultant, project manager, especially in the startup phase. And then financially, want to see those reserves that you've kind of built those cushions in for especially potential emergencies that might come up. And then financial systems and variance monitoring, really kind of how are you tracking against your projections? Are you doing that really on a consistent basis? We just want to know that you're watching those projections and how the store is performing. And then, of course, do you have adequate member investment to kind of get started up? And finally, we really, at least we can speak for ourselves, and I think other lenders too, we want to hear about any challenges you anticipate as early as possible, because you better believe we're going to talk about it internally if you don't tell us about it before. And so you might as well just put it up front. These are the things we think we might come up against.
Yeah, and there's one element there too is, there are some lenders who are kind of quick to jump to a no, that don't have the bandwidth to explore creative approaches to things, or are just looking for thresholds. And if you don't meet those thresholds, then go somewhere else. Most of the folks that are in the co-op financing world are not those kinds of lenders. We are asking the tough questions. We're looking for your weaknesses and the gaps in your capacity, not so that we can turn you down, but looking for them quickly so that we can then work together to figure out how we're going to shore those weaknesses up. And it might mean, you know, talking about staffing and who's doing what jobs. It might mean bringing in technical assistance providers or consulting services to help shore up some inexperienced areas in management. It might mean partnering with another co-op or you know, other groups, or with other local businesses and business service organizations too. There's a lot of different ways that we can make up for those things, but it does help if we can really spend time kind of picking at the weaknesses and the gaps so that we can spend even more time filling those gaps.
And then character. You know, we're going to assess the character of your co-op and your group of organizers from a lot of different standpoints. But, you know, one thing is, how have you built relationships and trust, both with us as a lender, but also kind of the broader community stakeholders that might be involved in your project. You know, during the underwriting process, we're going to have lots of meetings with you to really get to know not just hopefully one person from the cooperative or one board member, but a wide variety of people, and really see that you all have been working together. And if I talk to one person on Monday and a different person on Thursday, I'm not hearing different answers about the financial plan or, you know, marketing plan, that you're really all working well together. And yeah, you know, it's always great for us to be able to connect with those multiple players.
Yeah, it's ideally, you know, and it's common that there ends up being one point person for the loan application and the process, and we're really, you know, working with that one person primarily. But throughout that process, we do want to make sure that we are talking to more than one person, and usually that means somebody from management and somebody from the board, and maybe even some other member who serves on a different committee somewhere too, so that we can get some depth of understanding of the co-op and how it works. Yeah,
we had a question about how early one should start and how far along should you be in the development.
We are okay getting as early as you want to give us a call. So people, and we're happy to have those early conversations, because then we can offer some feedback and help set some thresholds to say, well, okay, it looks like you're at this place. Once you've gotten these 2 or 3 things done, let's check in again and see which direction things are going and what the financing need looks like at that time. But we get calls everywhere from, hey, we've got a package put together and we're ready to break ground and we need to fill a gap next week, to, I had a crazy dream last night and my friends and I want to start a co-op. We'll take any of those calls. And in fact, I would prefer to take the crazy dream call before the we need money next week call, because that'll give us time to figure stuff out.
Yeah, when I get those kind of calls, it's like awesome to be able to refer them to FCI or another TA provider to just say, okay, great, we can, you know, get you on that that planning process early, and hopefully ensure your success and sort of loan readiness down the road. So conditions are all about knowing the market that you're operating in, and I'm sure you're all familiar at this point with the market study. For us, it really, you know, I'm based in Minneapolis. I've certainly traveled places, but it helps me understand the framework, gives me a framework for understanding the context you're operating in and what does your market really look like. So that's really an essential piece for us to get that. But then there's more, right? It's not just reading the market study. I also want to know that you can answer all of these questions about who your customers are, how you're going to reach them. Do you really know your competition? And don't tell me people are just going to come to the co-op because you're a co-op, though there is a co-op advantage. It's like, why will your store be successful, and how have you kind of planned for that? And that, you know, really want to know that you understand any changes that are happening in the industry. And it obviously is a very competitive industry, and so you have to have a value proposition. But yeah,
yeah, I think the short story there is the market study is not a guarantee or promise of customers.
Right.
It is a measurement of potential customers, and you've got to do all the work to get those people in your door. So we don't, with the market study doesn't guarantee anything for us as a lender. It's the work you put into getting those feet walking in your door.
Yeah, and Don had a question about if we'd like to see a formal business plan with these types of questions answered. Absolutely. Yeah, thanks for bringing that up. That typically a business plan is really going to get at conditions in a deep way. And then there's those issues unique to cooperatives that I mentioned, a lender like Shared Capital will really care about. And that is ownership, understanding what role your members play in the cooperative, and then governance, you know, what kind of board do you have? Have you gone through training? You have clear policies and rules established, and then how are member benefits distributed throughout the cooperative, and what really is the financial benefit for members to be a part of your food co-op.
Yeah, and for these, you know, there are definitely some standards and best practices out there for a lot of the things on this page. And you'll learn about those things working with groups like FCI and National Co-op Grocers and Illuminate. But there are occasional variations, and people try slightly different ways, especially around things like member benefits. People might try slightly different approaches depending on their community and what they think the community would want. And we're okay with variations as long as they make sense within the financials and operations of the co-op. Mm-hmm. So we appreciate creativity and trying new things, as long as you understand kind of what risks you're taking and how to offset those risks.
There's a question from Don. Are you considering loans to startups at this time?
Yes, we have pretty much always financed both startups and expansions and renovations. So we did, though, slow down for a little bit a few years ago. And if folks are familiar with kind of the recent changes in the industry over the last 8 to 10 years, there was, you know, a significant wave of efforts and startups around the country, which was tempered a bit by a number of those stores failing, unfortunately, and others really struggling to find their place in a more and more competitive market, with larger chains taking a larger part of the previous grocery co-op world. And so we have tightened up our requirements and our assumptions about it. And so we tend to, as we mentioned before, as part of the trend, we tend to want to see debt be a lower percentage of the entire capital stack. We also make an assumption that it's going to take a store longer than it used to get to a positive cash flow. So it used to be a couple years and you're good. Now it takes a few years longer than that sometimes in some circumstances. And so we tend to be a little more conservative about how long it's going to take the store to get there, which of course means that we need to see a little more working capital in the pocket of the store when they open up their doors. So they got enough of a cushion there to get there. So there's a number of things like that that we have tightened up overall, but we are happy to entertain a financing request from a startup.
Mark, there's another question about our evaluation of the GM and the fact that it's part of our process, but typically stores haven't found somebody yet. So how does that work?
Yeah, sometimes we can sometimes move forward with loan approvals that have significant contingencies in them as well. So if there are a few things that are to be determined, but most of the store is figured out and most of the business plan is being worked on, we can occasionally approve a loan with the contingency that a GM is hired that we have some review over or ability to identify weaknesses or challenges with that person. And similar to what I was saying before is, again, if you've been looking around for a little while and thinking about this question, you've probably noticed that it's harder to find folks with extensive experience that really know co-ops and really know grocery stores, because they're all very busy these days, doing a lot of things. And so we do often find places where they're finding people from the non-co-op grocery world, or people that have a lot of experience in the co-op grocery world but have never been a GM before. And we are okay to entertain helping those folks grow in the field, but that's one of the situations where we'll probably want to have some conversations with you about the areas where their expertise is not strong and finding a way to shore that up. Again, either through complementary staffing or through consulting services or similar resources.
Thanks, Mark.
So those are that's the brain of the lender for the most part. That's what they're thinking about. These are the reasons they come at you with all these questions. So how do you prepare yourself for that? I think, again, like I mentioned, I think at the beginning, is this is a relationship. It's a financial relationship, but if you're working with the right lenders, it's actually a little bit more than that, because a good lender isn't just there to make that loan and get paid back. They're there to make sure that the business that they are lending to is successful. And that's really what we want. We aren't here just to make loans. We are here to make loans to co-ops so co-ops can be successful businesses. And so it is more than the financials, and it takes a while to really kind of understand the co-op, and the co-op understands us as a lender. And so that can take a couple of conversations sometimes before you really get to the, oh, okay, now I think I know how these folks think. And then things can work a little bit easier. So having those conversations early, like I said, we're not afraid of that, and digging into those things early is important.
Mark, there was a question from John about how we forecast positive cash flow and what loan sizes we can do right now, and when would we look for another lender to participate?
Yeah, so right now, shared capital with our own funds, we can make loans up to $700,000 or $800,000 or more with a single transaction. Most of our transactions are a little smaller than that in the grocery stores, but we have the potential to go that high. But usually when they're that large, or when we're looking at the need for a couple of $1 million in financing, we will turn to partner lenders and investors around the country and either structure as participation loans. So you might work with one of us primarily, but there's a second lender behind us that's buying a part of that loan and is in that relationship as well. Or sometimes there may be loans that sit side by side with one another in what we call a pari passu relationship, where both loans are essentially senior lenders next to one another. Or you may have a situation like we talked about earlier, where there is a true senior loan and a subordinate loan. And so we can explore different combinations of those things if it's a larger transaction.
Mm-hmm. And then how do we typically forecast positive cash flow? Based on what you were kind of saying before.
Yeah, I mean, I think we're looking at right now for a startup, just generic, no specifics of location or market. Our assumption is it's gonna take you several years to get to some positive cash flow. And so we're also gonna take your budgets, which has most likely been developed between yourselves and probably a consultant helping you with that. And we're gonna take your conservative version of your budget, and we're gonna hack at it with an axe even more and see what happens when challenges really arise and when problems pop up. And so that's some of that stress testing we're gonna do. So our expectation is we're usually starting with your projections, and then we're poking at them and playing with them to see what happens if a pandemic were to show up for some reason in some year, and how could the store deal with something like that? Obviously, that's a rare thing, and hopefully things are steadily improving there. But in real world scenarios, some significant financial challenges and operational challenges can pop up that were wholly unpredictable in the business plan. And so we want to know that there's enough breathing room, enough resource there for the co-op to work through that, figure it out, and get back on track. My assumption is that any business, no matter how experienced your leadership team is, needs to be able to survive at least 2 really challenging moments in its first few years of operations. So let's just assume those are going to happen.
Yeah. We had another question from Michaela about how early you should begin building relationships with lenders. And, I think for us at Shared Capital and for other co-op friendly lenders, that dream Mark was talking about, as soon as you have it and you're really ready to start organizing, we're ready to talk to you. Potentially banks, you might want to wait until you have a business plan, and then approach them.
More questions there?
No.
Okay. Again, as you're preparing, get all your ducks in a row. Not everybody needs to be a financial wizard, but you want to have as broad of an understanding, especially among your board, of the higher level concepts of what these dollars look like for your store and what it means. So as best as you and your leadership team can be, to spread that knowledge around with, again, the assumption that there's probably 1 or 2 people that are really the spreadsheet folks, and that's fine, but we want to be able to spread that knowledge so that the group can make good decisions around that. And while there is always a significant amount of passion and energy and optimism that goes into starting up a business. And that is important, crucially important to making a startup business successful. We do spend a little bit of time throwing some cold water on that. And we want to know that you can, again, through some real world scenarios, feel confident that your numbers are accurate and that you can accomplish what you're setting out to accomplish. This other piece here really kind of touches on some of what we talked about with the market study, and especially in the highly competitive grocery world, really understanding your identity as a store and how you operate as a store is going to make a big difference towards getting people in the doors. And so the best you can do to clearly articulate that both internally and externally is going to help us feel more confident about your ability to market the store and get those sales that you need. And at the end of the day, be prepared for change. Everything is moving all the time. We fully appreciate that whatever budget you share with us in 1 month is going to look different the next month because things are going to change and you're going to adjust as you move forward. So that is a part of the experience. You shouldn't feel like things have gone wrong because they started to change. It's going to happen. So just be prepared for it as best you can. And with that, we'll open it up a little bit more here at the end for any other questions folks have.
I have a question.
Great.
So earlier when you were talking about one of the potential sources of funding being impact investors, my question is, and I've heard that before, and I've always been a little bit wary about how that fits in with the cooperative democratic control. It's one thing to get a loan from shared capital cooperative or another co-op lender or even a bank, but when you're getting a loan from an investor, a personal investor, have you seen how that then impacts that whole sense of like who's in charge and who's running the co-op democratically?
Yeah, I mean, what the dangerous elements are when you start to really give up voting control rights into your store to investors. And the good thing is that there is an extensive and growing field in the world of social impact investing that has started to understand that they need to be able to put their money in community-owned enterprises and not expect to come in and take control of that community along with their money. And so more and more, we're seeing that as an acceptable thing. I can't say that it is a significant part of the investment world of investments, but at least it's something that we can point to more and more examples and models of if those investors you're talking to have concerns or see it as a strange thing. But if you're using a structure that uses a preferred share investment model for equity investors, or if you are simply setting up a promissory note with a local folks who have some resources, you can do either of those very easily without handing over any board seats or any real control to the enterprise.
Great, thank you very much.
Have you guys noticed Don's got his hand up?
Yeah, thanks. At the beginning, Samantha, you said that y'all, can't really speak for banks, but you might be able to give some idea of the differences between banks, which of course are highly regulated. And I thought if we had a few minutes, you might touch on what you know to be differences.
Yeah. So a couple of areas, I think, Mark was talking about debt service coverage ratios, and that we like, 1-to-1 is actually not ideal. We want to see more. We would like to see more, like you have $1.25 to every dollar of debt. Banks are going to have probably their own internal policies around what that specific number is, and they're going to be very unforgiving about that. And so whereas as shared capital, based on the project and social impact, is it in a CDFI qualifying area, which means a lower moderate income census tract? Is it primarily Black, Indigenous, people of color-led cooperative, that's going to be something that we will also take into account and potentially be flexible on some of those requirements, because we do have other considerations. We are a mission-driven lender. But banks, on the other hand, will say, okay, you didn't meet 1.25 or 1.3, we're not entertaining this project. Another piece is collateral, that they're going to want to see a certain collateral coverage for a $100,000 loan. They want to make sure that you have at least $90,000 in collateral, and they've already discounted it as well. And if you don't have that, they're probably not going to consider the loan, or they'll only go up to a certain dollar amount in a senior loan, and then you might have to come to shared capital or another organization to get a subordinate loan to fill the gap.
Yeah, maybe just a little bit of background there for folks too, because if you're not familiar with sort of how the banking world works, often it gets used as an excuse for banks not doing community development lending like they should, that, oh, we're regulated, we can't do that. But there is a grain of truth to that. And so I have worked over the years with many small, local, mission-based community banks that are regulated, and they really do start to run up against some walls sometimes with what they're allowed to bring into their portfolio. And so there is times when they really want to be creative and they just can't. And there are also times when they just don't want to be creative and they use that as an excuse. That said, there are community banks that do play a role in financing grocery stores all the time. And also another way that folks deal with that is to turn to the world of CDFIs, Community Development Financial Institutions. Like Samantha said, we are one of those, but there are thousands of these around the country. So many of them just do affordable housing, some do nonprofit facilities, but there are many small business CDFIs out there too that also have some rules around how they operate, but they have a lot more flexibility around those particular terms typically.
Mm-hmm. And if you do have a CDFI in your community, say that really aligns with your mission and values, or because you're in their community, they're going to support you, but they don't quite understand this co-op structure, we are certainly a resource, even if we're not going to be brought in for financing, to connect them with us, so we can talk to their loan officer, their director of lending, to just help them understand what it would mean for them to lend to you.
Sometimes those are great opportunities to do that co-lending thing or a participation loan, because they get to be a local relationship and a local resource for that co-op. We're national, we can't be there every day, but we get to be the folks that can help that local bank get more comfortable with lending to a co-op and to understand the nuances of that.
Can I ask you guys a question going back to Michaela's question? I just want to flesh this out a little bit about how soon should we start talking to lenders, and you're like early, which you always hear. I think a lot of startups feel like, how do we have enough together to call you? Like, what would we say? Can you just walk us through a little bit of like how someone would approach you if they're not even sure they're ready, but they want to be on your radar?
I like to, on that first call, I don't want to talk numbers. I want to talk about the story. I want to understand what's the story of this co-op. Who are these folks? What are you trying to accomplish in your community? And how is this store going to accomplish those things for you? Maybe on the second or third call, we'll start to get into numbers. You have your own style, maybe.
I think that's absolutely it. And yeah, I like to hear, I think, a little bit about who you think is going to be coming to this store and why this store is going to be meaningful, just more additions to what the story, hopefully, you can tell.
Great. Other questions? Because I'll keep, I've got more, I'll circle back, but I want to let you guys talk.
Go ahead.
All right. I just wanted to go back to the CDFI zone thing. I think you did talk a little bit about, if you know what that means, I'm going to put a link actually in the chat to where you can find a map and you can search if your co-op is in a CDFI zone. But if you can tell what are the qualifications for that, and why does it matter so much? Why does it change your interest in the loan?
Yeah, so CDFI qualification, I should clarify, is different for every CDFI. So for us, we're qualified based on census tracts, and those census tracts are low and moderate income. They change every 5 years typically. We'll get some new data. And that for us, that's all about our mission that I mentioned in the beginning of building a just and democratic economy. We want to prioritize, low wealth communities, communities of color that haven't had the access to capital. We're all about trying to be as flexible as possible there. Some other CDFIs might have other ways that they are certified. It might be by different ethnic and racial groups leading projects, things like that. It sort of depends, but for us, it is based on physical location, and that helps us get access to federal dollars every year. That kind of helps the fund continue. So it's our personal mission as an organization, but also kind of the funds help us continue in perpetuity, hopefully. And JQ, one thing, you put in the place where people can find if their store is located in a CDFI qualifying census tract. That's great for you to know. And also when we were talking about other CDFIs that might be available, I can put or maybe you can put the CDFI locator search.
I didn't actually find the locator. I put up the cdfifund.gov where there was a list of certified CDFIs, but I didn't. It's not like a search tool. If there's a good search tool, we'd love to see it.
Yeah. I will put it.
Because some CDFIs are very regional. So, Shared Capital is national, but some CDFIs serve a very specific area. And if there's one serving your specific area, it doesn't hurt to know if they work with projects like yours.
Yeah, and the CDFI qualifying census tracts is important to us, and a majority of our lending needs to take place in those places. But we can do lending outside of those, but we can't prioritize that kind of lending. And it is as you might imagine, a clunky and inaccurate system to the degree where frustratingly often a store is located across the street from a CDFI qualifying district. And so it's like, obviously they're going to serve people in that broader market. So they're working, even in the world of CDFIs, you will run up against certain bureaucratic frustrations as well.
Any other questions? I want to point out Shared Capital very specifically, and there are other co-op friendly lenders. This is not the only one. Play a very specific role for startups. So if you have been talking to a local lender and that's looking pretty good, but they may not cover everything, still call cooperative friendly lenders. A lot of them not only will partner with your local lender, but I have personally experienced a lot of them, and I'm sure you guys tell over and over again, have educated your local lenders because they don't know what a food co-op is. And so to work with a food co-op and help bring them in on partnerships and on projects and help them understand the structure of co-ops. So even if you're like, we're really gonna try and work with local lenders, if there's any role possibly for a co-op friendly lender, I'd still reach out to them because quite often they end up playing a role in helping you pull the whole project together. Yeah.
Great.
Agreed.
Well, thank you very much.
All right, everyone. Well, thank you. I'm gonna get a couple quick things I want to share with you all before you go, but I want to thank first off Mark and Samantha for being here with us today and donating their time to share with you guys and educate. A big round of applause for them. I really appreciate them. And I just want to say this is the end of the series, but we would love to hear your ideas for the next one. We got a lot of compliments on the mix of content this fall, and that's because you guys told us what is new, what you're needing to hear more about, what you haven't heard enough about, all sorts of, and some of you even stepped forward and said, we'd like to talk about our experience with X. All those kinds of things are welcome with FCI Live. So please do reach out to us. We'd love to hear what you'd like to see in February. Can't end the session without thanking the people who make these sessions possible: the USDA Rural Development Center, National Cooperative Bank, National Cooperative Grocers, and CoBank. And hopefully you saw our last email about FCI Live at the bottom for our upcoming deep dive training events. There's one coming up in October for the West Coast, another coming up in November for the South. If you are in the Midwest, Central, and East, we got you coming up early next year. So thank you all so much for coming out and spending the time with us. And thank you again to Shared Capital.
All right. Bye-bye.
Bye, folks. Anyone wants to stay and ask some questions off the recording, feel free to do that.